Okay, hi everyone. This is going to be the second lecture for chapter 11. So we're picking it up here about halfway through. So a few things we got to talk about, like changes in estimates, changes in methods, and then if there's an error, right? So we're talking about just like generally cost recovery. Maybe let's just say we're talking about depreciation, right? So say we have a change in estimate, right? We're going to account for this, right? So we're kind of plugging along. Then we say we're depreciating this thing, and then we say, oh, here we are right here. We're going to change an estimate, right? In other words, hey, maybe we think that there's going to be a different useful life, right? Maybe we think at that point in time that there's going to be a different residual value. Right. Well, the idea for this is we're going to account for this prospectively. In other words, we don't go back and restate anything. We just kind of adjust for it and move forward. You're going to have a disclosure note in there for it. So we have an example here, right, on January 1st, 2022, right? So on 1/1/22. Right? They purchased a machine for $250. At the time, they estimate, so their starting estimate was that, hey, this thing is going to last 5 years, and there's a residual value of $40,000. Okay. On January 1st, 2024, right? So like 2 years in on 1/1/24, they say, uh-oh, we need to change our estimate here, right? We now think that it's going to last 8 years, and we think the residual value is going to be 22,000, right? So we're changing those things. How do we kind of account for this? Right. Well, the first thing is we got to get and make sure that, hey, up until this point of time, right, when we change it, we get the appropriate book value, right? So we're going to take cost minus the depreciation to date, right, under that old method there, right? That's going to get us $1.66 as our net book value on that date. That's great. Then what we do is, right, we're going to back out the revised, right, the new residual value, right? So it's 166 minus 22, the new residual value, that gets us 144. And we will divide that over the remaining, right? So this was 2 years in, right? We said it has an 8-year life, so there must be 6 years left, right? There we go. There's our new annual depreciation, right? So debit depreciation expense, credit accumulated depreciation. Essentially what we did here is we were moving along, we changed an estimate, we just account for that prospectively, moving forward, adjust for it accordingly. MCQ you can look at, right? When those kind of things happen, you would make a disclosure note. How about if instead we change, right? We're not changing an estimate, but we're changing the method, right? Maybe we go from double declining balance, right? And we change to straight line, right? We're like moving there, and then we make an idea, hey, it's better to change to a different method here. How do you account for that? Right? Well, it's also, as a general rule, going to be, a change in accounting estimate. We're going to treat it prospectively, right? We're just going to kind of deal with that as we move forward. In other words, we don't go back and restate anything. We just deal with it as we move forward. Okay, so same kind of setup here, right? It looks like on 1/1/2022, right? They purchased the machine for $250. They expect the service life of the machine to be 5 years and residual value of $30,000, right? So they think originally it's going to be 5 years with a residual value of 30, and they're using double declining balance to depreciate that. Okay, it's like what they were originally doing. Now they say, hey, during 2024, the company switched from, right, we were using double declining balance. Now we want to switch to straight line, right? How do we deal with that? Okay, so the first thing we got to do is take the cost, right? The 250. We got to get it, our back out any depreciation up to the point in time we make that switch. So $1.60, right? How you would calculate it over here, that using double declining depreciation. That's our undepreciated cost as of 1/1/24. We back out the residual value. Hey, there's our depreciable base. And again, we're moving to straight line here. So hey, our base is 60. There's 3 years left, right? Because there was 2 years there and then 3 years left on that remaining 5 years. We do the 60 divided by 3. Hey, there's our depreciation expense going forward, 20,000, 20,000, 20,000. Okay? Now you'd put a note in there for that. There's an MCQ you can look at. How about an error, right? Well, an error, right? Maybe we're doing some financial statements, right? We have like year 1, year 2, year 3, and then hey, in year 3 we say, uh-oh, we screwed up in year 1, right? There was an error whenever we calculated depreciation, amortization, or depletion, right? How do we deal with this? Well, the general rule here is it's going to be retrospective. In other words, we're going to have to go back and basically, look at those financial statements and look at the effects from those, right? And then in the current period, have a prior period adjustment to retained earnings to account for those effects, right? So if we look at this example, right, it looks like in 2024, the controller of a corporation discovered an error in $300,000 in legal fees to successfully defend a patent. So what's going on here is it looks like the $300,000 was expensed, right? So what they did was they expensed it, but because they won the lawsuit, we'll talk about this at the end of the lecture, they should have capitalized it, and then amortized it, right? So they should have amortized it over 5 years, straight line for the, amortization is used for intangibles. So what's going on here, right? It looks like we have 3 years, right? There's kind of year 1, year 2, and then year 3, right? Here is what we did up here. We took a $300 expense in year 1. What we should have done, right, was had $300, capitalized because we won that lawsuit. We were successful. We'll talk about that later in the chapter. And then we would have taken a $60 expense in year 2, a $60 expense in year 3, right? Kind of, write that patent down. So what we got to do here is, right, we essentially have to say, well, what are the cumulative effects of this? In other words, 2023 and 2022 and 23 financial statements that were incorrect as a result of the error are retrospectively restated, right? So we're going to have to go back, restate these years to kind of do the correct thing that we were supposed to. And then the cumulative effects of these guys, right, we're going to have to make a prior period adjustment to retained earnings. So in other words, what we did is we took a giant expense of 300,000, right? But we should have only taken an expense up until this point in time of 120, right? So the difference there between that, right, is going to be 180, right? So in other words, we took too big of an expense by 180. Now we're going to have to reduce, not reduce. We have to increase our retained earnings, right? We got to undo that expense. Likewise, when you think about the patent that's sitting on our balance sheet, right, it should have been at, after these years, 300 minus 60 minus 60, right? So it should have been at 180 on there. But how they have it on there, right? It's at zero because we expensed the whole thing in year one, right? So that other difference, right? That's where we're gonna get the patent debit patent 180. Okay, so prior period adjustment for it, right? Error, you got to go back and kind of restate and look at the cumulative effect of that error. Change in estimate or change in method, you just deal with prospectively moving forward. All right, next thing here is impairments. We're going to talk about impairment with regard to fixed assets and intangibles. The general rule, at least with regard to fixed assets, is you're not going to test them for impairment unless there's like some type of reasonable facts or circumstances that would indicate that you need to test them for impairment. And in that way, whenever those facts and circumstances happen, right, you have to see if the impairment loss, you got to look at the asset, was that held for sale? Or is it being held in use, right? Are we using it? Or are we holding it for sale? Okay, so with regard to assets held and used, right? We're using this asset in our business, a fixed asset. It should be written down if there's been a significant impairment of value, right? A write down can provide important information about the future cash flows. Even if the significant impairment of value has occurred, it is often quite difficult to measure the amount of the write down. And essentially, for assets to be held and used, different guidelines are applied to property, plant, and equipment, as well as intangible assets with finite useful life. That is to say, those that are subject to depreciation, right? So PP&E, you depreciate. Intangible assets with finite life, you amortize. Whereas in distinction, right, you have intangible assets with indefinite useful lives that are not subject to amortization. So that might be something like goodwill, right? So we're just kind of creating the framework here for what are the different situations and setups we test for impairment. One of the things here, it says, according to GAAP, assets are grouped at the lowest level for which identifiable cash flows are largely identifiable cash flows are largely independent of the cash flows of other assets. When do we test for impairments? In other words, we have PP&E on our books, it's sitting there. Generally, you're not going to test for impairment. When you would do that, however, when you would test for it is when there's some type of change or event, circumstances that would make it reasonable to test for impairment. In other words, only if the events or something happens that would indicate that the book value of the asset or the group may not be recoverable, right? So there's all these kind of situations that could arise, right, that would give indications that may happen, right? Maybe there's a significant decrease in the market price, right? All of these different scenarios there. When that happens, right, whenever there's sort of a change that would make it reasonable to test for impairment with regard to PPE, we have a two-step process in this case. And really what we're doing here is we're going to line up our undiscounted future cash flows. We're going to have our net book value, and then we're going to have our fair value, right? Step one is going to compare these guys, right? And it's basically just saying, hey, is there impairment? Like yes or no, right? Yes or no, right? It's just kind of showing us if it exists, right? So if yes, then go to step two. If no, you're done. There is no impairment. Just leave it be. Step two then says, hey, if you had yes to step one, you're going to compare the net book value with the fair value. In other words, we're going to put a number on this impairment to figure out how much impairment is. So kind of two-step process here. Hey, there's facts and circumstances that would make it reasonable to test for impairment for a fixed asset. Step one, is there impairment? Step two, how do we quantify, or what is the number of that impairment? Right, so we said here, right, we're going to compare those three things. Fair value, right, one of them was undiscounted cash flows. right? This guy right here, it's undiscounted. Do be aware that fair value, a lot of times we are going to, whenever we figure that out, discount it. So there's differences there. These numbers will be given to you. You need to know how to apply the framework, right? I'm not going to have you look into a crystal ball and speculate on these things, right? And that's what this guy is saying here. So let's look at an example and kind of tee these things up, right? We have step 1, step 2, right? So we got step 1 where we're comparing essentially here the undiscounted future cash flows, right? So in this case, right, we got $1.50, right? Undiscounted future cash flows. And we have a net book value in this case of 170. Right, so it looks like there's a factory that blah, blah, blah. A change in business climate. Oh, okay, the facts are reasonable to tell us we should test for impairment, right, for some of the assets on there, right? It may not be recoverable. They say, hey, we estimate that the future cash flows over the remaining useful life will be $1.50. The fair value of the assets is not readily available, but it is estimated to be $135. Okay, step 1, I think we made it blue, right? We have to compare the undiscounted future cash flows with the book value. If it exceeds, right? In other words, 170 is bigger than 150, then yes, there is impairment. We move to step 2. If no, right, if it was like, this was like 130 and it's less than, then the answer would be no, and we're done, right? You don't move forward. But let's kind of continue with this here, right? So I'm going to copy this. I'm going to put it over here, right? So we said step 1, we compared, the answer was yes. That's great. Now what we do is we go to step 2, and we essentially compare the fair value, in this case 135, with the book value 130. In this case, right, because the fair value is less than the net book value, we have impairment, right? That's how we get the number for step 2. Right, so here, right, the fair value is 135, the book value is 170, right? So fair value 135, 170. Our impairment is 35, right? So we're going to do debit loss on impairment, right? We'll get rid of the accumulated depreciation from up here, and then we'll credit the factory asset as well, right? So we're kind of just like teeing up that fixed asset on there for where it needs to be, okay? Right, there you go. You can look at that. Obviously you'd put a note in there. Don't worry about IFRS. You can read through this COVID stuff. Not really concerned with that. That's like, just giving you some context for it. But we talked about impairment with regard to PP&E. There would be some type of fact or circumstance that would make it reasonable to test for impairment. We have that 2-step process, right? So PP&E, 2 steps for impairment. However, when we have goodwill, right, which would be essentially an intangible asset with an indefinite life, right, it's going to be 1 step for impairment, right? In other words, whenever we have goodwill on there, it's going to be more frequent that we test for impairment, maybe yearly, right? We don't necessarily have to have this sort of like preceding event. And essentially, it's going to be a 1-step process on there. In other words, we are going to compare, in this case, the net book value with the fair value, right? Step 1, right? That's it for goodwill on there. If the fair value is less than the net book value, right? So I don't know, maybe let's just say this is 80, this is 100, right? It's less. Well, then, hey, we have a loss. If it's not less, then we don't have a loss. You don't do anything. This is like part of the problem is people just like plug the numbers in and they don't think about it. Only if it's less do you have an impairment loss. So that's the idea there. You're going to write it down and it's going to become the new cost base for future allocation, right? So don't worry about IFRS stuff. Don't worry about that. We will look at an example here with it, but one of the things be aware of with goodwill, right? We talked about this before. It's traditionally when you see it, it's going to be when one business buys another. Internally generated goodwill is kind of speculative. It's too hard to figure out. When we do have it, right, the level of testing for goodwill is going to be at the reporting unit, right? So a reporting unit is essentially an operating segment. We'll see this in the example on there. And essentially what we do is we compare the value of that reporting unit with its book value, right? So again, we're essentially comparing fair value with net book value. And in this way, right, if there is a loss, it's not going to be able to exceed the book value. And it says here, if goodwill is tested for impairment, the other assets must be tested first, blah, blah, blah. Not a big deal there. Here's an important point, though. Subsequent reversal, recovery of previous goodwill impairment loss is not allowed. So in other words, this is important. If you do test for impairment for goodwill, right, there's step 1, and you're like, okay, we do have to have impairment on this, right? And it gives us the number. It's just one step for goodwill. If we then write it down, right, for the impairment, we are not allowed to write it back up, right? Subsequent reversal of previous goodwill impairment loss is not allowed. Let's look at an example here, give this some numbers, right? So we said goodwill is typically going to arise when one business buys another. Here it looks like a corporation acquired pharmacy company, right? That's great. They gave 500 million, and it looks like they got 400 million worth of stuff, right? So the difference there is going to be $100 of goodwill, okay? And it says, at the end of 2024, it looks like they're testing it for impairment, right? And in this way, right, we know that it's a one-step process, right? So step 1, right? And they basically they're going to test this at the reporting unit, right? Essentially, they're separating here kind of the corporation from, the pharmacy unit. These guys are different things, and they're testing it at the pharmacy unit. And they basically are looking at, in this case, it looks like the book value of that pharmacy unit is going to be 440. And then the fair value of that unit is going to be 360 fair value, right? Because the fair value is less than the net book value, we have impairment, right? The difference there is going to give us the number, 80 million, right? So we're going to then take a loss for 80 million and then reduce that, right, by 80 million over here, the goodwill, okay? MCQ you can look at, right? This is just saying, hey, be aware some companies have done this, right? They would put a footnote in there. Don't worry about IFRS stuff on there. Don't worry about COVID stuff on there. And then this assets to be sold, right? You can look through this, for there. There's kind of a summary with all of that impairment on there. When we talk about impairment, right, you do have to be aware that that's essentially like an expense or a loss, right? So it's like debit, impairment, loss, right? That's it's normally like a 1-year thing, right? In other words, it's not like year over year, that you're going to have this. It's whenever you test it and it shakes out this way. So it's going to be transitory. Yeah, it could happen in year 1. It could happen in year 2. But if that is the case, then we kind of probably screwed up the accounting somewhere up front in our estimates. So just be aware when you're looking at financial statements and you see the effects when you're looking at the earnings. If you saw something like an impairment loss, oh, okay, this is probably like a 1-year thing. We're not going to see it year over year. Okay. So continuing, right? We've talked about, in the last chapter, all of those costs, right? Until we kind of flip the on switch, right? We're going to capitalize. Then we talked about so far, right? After it, you're going to depreciate the fixed asset. We talked about the different ways. There's amortization, right? All that good stuff. What happens, right, if afterwards, right? So here we are, right? You throw more money into this fixed asset, right? So maybe it's like we buy an ice cream machine, right, for McDonald's or something. That's great. All of those costs, right? Maybe up until we flip the on switch, it's $1,000, right? Afterwards, we have to distinguish if we throw more money into this thing, are we going to capitalize it and then depreciate it like a capitalized improvement, or are we going to expense this thing? Well, it really depends, right? A lot of it is like, well, how big of an expense is this? Is it material? As a general rule, right, whenever we do this, right, the general rule is going to hold that if it's routine maintenance, you're going to expense it. If it is like a very large material or like it's like a one-time thing, you're going to capitalize it and then depreciate it. There's a couple different kind of variations on the spin you could put for that. But by way of example, right, with the ice cream machine, if it just needs like a new hose or something, right, these McDonald's ice cream machines break down all the time, right? Some guy comes in and fixes it for $50, you'd probably expense that. If, however, right, it needed like an entire new inside, right? Like we have to replace basically the whole insides of that ice cream machine, you'd probably capitalize and then subsequently depreciate that, right? So this is just kind of talking about that. Hey, if you throw money into it after the fact, you have to distinguish, is it routine maintenance or a capitalized improvement? Does it create future benefits, right? Will it increase the useful life? Will it make it more efficient? Will it increase the quality of the goods and services, right? So in this framework, right, whenever we throw the additional money in and we're like, do you capitalize it or do you expense it? Sometimes companies will just have a materiality threshold to tell us what to do, right? So like, hey, if anything, if regardless of what this is, if it's less than $1,000, right, we're just going to expense it, right? That's, companies can have that kind of policy for it. We said that generally, right, if it's repairs and maintenance, you're going to expense it, right? So, hey, an engine tune-up, you'd probably expense that, right? That would be reasonable to do it. You can read through there on it. It's what you would expect, routine maintenance. But if it's bigger, right? It's like an addition, right? You'd probably have to capitalize it because future benefits are increased, right? So we're not doing an engine check now like a tune-up. Instead, right, we're adding a whole refrigeration unit to that delivery truck, right? That's going to create future benefits. Accordingly, you're not going to expense that. Instead, you're going to capitalize the refrigeration unit and then subsequently depreciate it. Right. Another situation might be is like, hey, we have a building. You do a whole addition to that building, right? You're not going to expense that whole addition. That's going to create kind of a capitalized improvement or potentially a new and different asset that we have to depreciate. Right. So improvements, this says this involves the replacement of a major component of an asset. Right. So with regard to replacement, the new component with the same characteristics as the old component, or a new component with enhanced operating capabilities. In either case, right, this is going to increase future benefits. We're going to have to capitalize this and then depreciate it over the useful life in there. So let's look at an example, again, kind of building off this. An existing refrigeration unit in a delivery truck could be replaced with a new but similar unit or with a new and improved refrigeration unit. How we would account for this, right? We're probably going up, the top line here, capitalizing it versus immediate expenditure. But how we capitalize it, right, an improvement here, they kind of give you a few different ways, right? You can have a substitution, you can straight up capitalize it, or you can reduce accumulated depreciation. There's kind of a few different ways to skin the cat here, right? So we have kind of option A, option B, and option C, right? We're talking about, a new component to a refrigerator. Let's look, we'll just say, hey, there's option A where there's a substitution, there's option B where we capitalize it, and there's option C where we reduce accumulated depreciation. Let's look at an example, give it some numbers on here. We're looking at option A with a substitution. Okay, so if we substituted here, we essentially have to do two journal entries, right? Journal entry 1 is going to be to essentially get the old off the books, and then journal entry 2 is going to be put the new on the books, right? It's kind of a substitution there. Let's look at this with an example. Right, so a corporation replaced the air conditioning system in one of its office buildings that it leases. The cost of the old air conditioning system was $200,000. It included the cost of the building and is included in the cost of the building, right? So whenever they did like debit building, this air conditioning unit was part of it. However, the company separately depreciated the air conditioning system. Depreciation recorded on the date of replacement totaled $160,000. The old system was removed and the new system was installed at a cost of $230,000. Parts from the old system were sold for $12,000. Okay, so we're looking at option A here, substitution. We got journal entry 1 where we got to get the old one off the books, right? So they said here, I underlined old with all that. So one of the things is parts from the old were sold for cash, $12,000. That's great. And then it looks like, right, we got to get, $200,000 that was on there. That's how much we had it for with the accumulated depreciation of $160,000, right? We got to get that off the books. Right, we got the 12 right there. And then what we're going to do is, right, we can plug the difference here for a loss, right, of 28,000. Right, so there we go, journal entry 1, get the old off. Now we have to do journal entry 2 where we get the new on, right? So the new we paid $230,000 for in cash, right? So it's just kind of like a substitution effect there for it. So that was option A. We have option B, right? This is another way we could deal with it, right? We're just going to capitalize the cost of the new building. And essentially what we do here is we say, okay, the new building cost us, or the new air conditioning system cost us $230,000. We sold the old for $12,000, right? The difference there, right? We're just going to capitalize as part of buildings because the air conditioner is part of the buildings. Debit buildings $218,000, credit cash $218,000, right? So option B is pretty straightforward. We're looking at $218,000. Option C, we're also using that same $218,000 number here, but option C says, hey, we're just gonna skin the cat a little bit differently here, right? Gets us, kind of a similar place. Instead of teeing it up this way in option B, we'll just reduce accumulated depreciation by $218,000 to kind of get that building where it needs to be on the books and records. Okay. Talk a little bit here about rearrangements. So these are expenditures made to restructure an asset without addition, replacement, or improvement. In other words, they create a new capability for the asset. And they don't necessarily extend the useful life, right? So for example, right, the rearrangement of machinery on the production line to increase operational efficiency, right? So maybe we have machine A, right? We have machine B, and we have machine C, right? If we were to kind of move these around in the production department, right? Maybe we have to like uninstall machine A and move it over here in the production process, right? And that costs us money, right? It doesn't necessarily extend the life of machine A, but it is a restructuring cost. It's money related to moving that around. Somehow this is going to increase our operational efficiency by doing this. So the question becomes, how do we account for these rearrangements? Well, essentially, you got to see, is it material or not? That's one of the first things, right? If the rearrangement expenditures are material and they clearly increase future benefits, then we're going to capitalize them and expense those capitalized costs over the periods benefited. If they are not material or it's uncertain that we're going to have future benefits from it, you're going to expense it, right? So when we move machine A in the plant, right, and that costs us some money, right, that's a rearrangement. If that's material and we expect future benefits, capitalize those costs. If it's not material or we can't really figure out those future benefits, just expense it, okay? Summary chart there for you to look at. A few other things, right? How about the cost of defending intangible, right? So there's going to be a lawsuit, right? In other words, someone sues us, right? We got to defend it, right? Maybe we have the copyright to a song, right? And, you know, somebody else says, hey, you stole the beat or the rhythm from my song. I'm going to sue you, right? Well, what happens is we got to look, right? So we essentially, right? Maybe we have the copyright right to some kind of song, right? We got a guy over here, or a girl, and they're like, look, I'm suing you, right? You stole, the rhythm, the beat from it. So we have to go and pay a lawyer, right, a bunch of money to help us in this case. The question becomes, what do we do with these costs? Well, it depends, right? You have to look at the outcome of the suit. If an intangible right is successfully defended, in other words, if we win the lawsuit in this case, then those costs for the lawyer, we're going to capitalize and amortize them over the remaining useful life of that copyright. However, if we lose the lawsuit, then we expense the fees, right? So you got to separate here. Do we win? Capitalize. Do we lose? We expense. Don't worry about IFRS. These next few slides, I'm going to leave to your tax class, right? Suffice it to say, and I don't know why they do this stuff where they try to put like, other classes into this class. Like I get sort of the connection, but good God, this PowerPoint is like already 120 slides. Be aware, and we mentioned this in the last lecture, that there's a difference between how you calculate depreciation for financial statements and tax. Not going to test this. You'll learn about it more in your tax class, okay? And then finally here, right, they talk a little bit about, retirement and replacement depreciation methods, right? So what's going on here, right? So we usually would use these whenever there's relatively low cost asset, right? It's like a calculator for 50 bucks, right? We have two methods here, right, that can help us, right? We have the retirement method, and we have the replacement method. So it says the retirement and replacement depreciation methods are occasionally used to depreciate relatively low valued assets with short service lives. Under either approach, an aggregate asset account that represents a group of similar assets is increased at the time of the initial collection is acquired, right? So, hey, we buy those guys, right? Debit calculators, credit cash, right? If we're talking about the retirement method, right? So there's two methods, right? We're talking about the retirement method. Whenever we buy more calculators, right? We're going to do debit calculators, credit cash. That's great, right? So we buy more. And then whenever we sell some of the calculators, right? We're going to do debit cash, credit calculators, and then the difference there we're going to plug to depreciation expense, right? That's how we get the depreciation expense on here. Do be aware, right, whenever they calculated what they sold there, that was on a FIFO basis. So in other words, from the original purchases, what we expense first in, first out. How do we deal with it, right? So we talked about the replacement. How do we, or not the retirement approach, how do we deal with it under, the replacement approach, right? So it's going to be the same journal entry for when you buy it, right? That's great. However, whenever you buy more, right, we're going to have a different journal entry, right? Here we take the depreciation expense for essentially what we got to record the replacement depreciation of the calculators, right? It's, we're basically replacing, the old calculators here with it. And then whenever we sell under the replacement depreciation method, right, we'll do debit cash and we'll hit depreciation expense for that. So if we were to kind of compare these guys, right, we have, kind of the retirement method, when we have the replacement method, right, we're using this to help us calculate depreciation on relatively low cost assets, right? So we have, whenever we buy it, right, it's going to be debit, whatever the fixed asset is, the calculator, credit cash, right? That's the same for them, the initial purchase. Then we have buy more, right? We buy more calculators, which are essentially going to, account for, the old ones aren't good anymore. We buy more. Over here, right, we do debit fixed asset, the calculator, credit cash. We repeat what we did, but down here, right, it's going to be different. We're going to do debit depreciation expense, credit cash, right? So here they're different. Over here, they're the same. And then finally, when we go to sell those guys, right, under the retirement method, we just do debit, in this case, the cash, debit depreciation, which is going to be a plug, and credit the fixed asset. Over here under the replacement, right, we're going to do debit cash, credit depreciation expense. So they're different on there. Okay, so that's it for this lecture. We will next do the problems.